Here's something most people don't realize until it's too late. Just because a bank says you can afford something doesn't mean you actually can. And that gap between what you're approved for and what you should realistically spend is where a lot of financial problems begin. When a lender evaluates you, they're not looking at your life the way you do. They're not thinking about your goals, your stress levels, your desire to invest, or your need for flexibility. They're looking at numbers on a screen. Your income, your debt, your credit score, and a set of formulas designed to determine the maximum amount of risk they're willing to take on you. That's it. So when you walk into a bank and they tell you that you're approved for a $500,000 or even $700,000 mortgage, it feels validating. It feels like you've made it to a certain level. But what they're really telling you is the upper limit of what they think you can handle before things start to break, and even that is optimistic. Because those calculations assume a perfect scenario. They assume your income stays consistent. They assume you don't suddenly face unexpected expenses. They assume you're okay allocating a huge portion of your income toward housing every single month. They don't account for real life. They don't account for the fact that maybe you want to travel, maybe you want to invest aggressively, maybe you want to start a business, take a career risk, or simply not feel stressed every time a bill comes in. This is where people get into trouble. They see the approval number, and instead of treating it like a ceiling, they treat it like a target. They stretch to meet it. They justify it by saying, well, the bank approved me, so it must be fine. But approval is not the same as affordability. Affordability is about margin. It's about what's left over after everything is paid. It's about how much breathing room you have in your finances. Because that breathing room is what allows you to build wealth, not just maintain payments. Let's say you're earning $120,000 a year, and a bank approves you for a mortgage that comes out to $3,500 a month. On paper, that might fit within their guidelines, but once you factor in taxes, utilities, maintenance, insurance, and everything else that comes with owning a home, you could easily be looking at $4,200 to $4,500 per month. Now add in your other expenses, car payments, groceries, subscriptions, insurance, maybe student loans. Suddenly, a huge portion of your income is gone. And what's left? Not much. That's the difference between being approved and being comfortable. Someone who buys based on approval might have a nice house, but they're constantly managing cash flow. They're delaying investments. They're hoping nothing goes wrong because there's no room for error. On the other hand, someone who buys below their approval limit creates space. They might qualify for $500,000 but choose to buy at $350,000. Their monthly payment is lower, their stress is lower, and most importantly, they have extra money to invest, save, and grow. Over time, that difference compounds, because while one person is locked into a high payment, the other is building assets. And assets are what eventually give you options. This is especially important in 2026, where interest rates, inflation, and overall cost of living have changed the game. The margin for error is smaller. Everything costs more. So the consequences of overextending yourself are even more severe. Another thing to consider is how lifestyle inflation plays into this. When your income increases, it's tempting to upgrade everything. Better car, better house, better everything. And the bank will happily support that decision by increasing the amount they're willing to lend you. But just because your income goes up doesn't mean your expenses need to rise at the same pace. In fact, that's one of the biggest traps. If every raise leads to a bigger mortgage, you never actually get ahead. You just maintain a higher level of obligation. And that obligation limits your flexibility. It limits your ability to take risks, to switch careers, to walk away from something that isn't working. Because now you have a large fixed payment that needs to be covered every single month, no matter what. That's the part most people don't think about when they're sitting in a lender's office, hearing that they've been approved for more than they expected. They're thinking about the house. They're not thinking about the commitment. And the commitment is what follows you long after the excitement of buying wears off. This is why the most financially stable buyers often do something counterintuitive. They aim below what they can afford, not because they have to, but because they want to. They understand that the goal isn't to maximize the house, it's to maximize their financial position. They'd rather have a smaller payment and more freedom than a larger house and constant pressure. And this mindset shifts everything, because instead of asking, how much can I borrow, they ask, how much do I actually want to spend? That one question changes the entire outcome. It puts you back in control instead of letting the bank define your limits. And once you start thinking that way, you begin to see approval numbers for what they really are. Not a recommendation, not a goal, just a number on paper that doesn't know anything about your life, your priorities, or your future plans. When people think about buying expensive homes, especially in the $1 million to $2 million range, they almost always focus on income. They imagine someone with a massive salary walking into a bank, getting approved, and simply paying the mortgage every month like it's no big deal. But that assumption misses a huge part of the picture, because at higher price points, income alone is rarely the full story. In fact, the real advantage comes from assets. This is the hidden layer that separates someone who looks wealthy from someone who is financially structured to stay wealthy. And once you understand how assets play into high-end home buying, you start to see why certain people can comfortably afford things that seem completely out of reach for everyone else. Let's start with a simple idea. Income is active, assets are leverage. Income is what you earn from working. A salary, a paycheck, a business that depends on your time. Assets, on the other hand, are things that can produce value without requiring constant effort. Investments, rental properties, equity in businesses, stocks, and other appreciating resources. Now here's where it gets interesting. When someone is buying a $1 million or $2 million home, they're often not relying solely on their paycheck to justify that purchase. They're using a combination of income and assets to support the decision. For example, someone might be earning $250,000 per year. That's a strong income, but on its own, it might not comfortably support a $2 million home. However, if that same person has a $500,000 investment portfolio generating returns, or owns rental properties bringing in monthly cash flow, the equation changes completely. Now they're not just earning, they're supplementing. That additional income from assets reduces the strain on their primary earnings. It gives them flexibility, it creates a buffer that most people simply don't have, and that buffer is what makes higher priced homes sustainable. Another major factor is equity. Many high-end buyers are not starting from zero. They're not first-time buyers saving up their very first down payment. They've already owned property, and over time, that property has increased in value. So when they sell, they walk away with a significant amount of equity. Let's say someone bought a home years ago for $400,000, and now it's worth $800,000. After selling and paying off the remaining loan, they might walk away with $300,000 or more in cash. That cash then becomes the down payment for the next property. So instead of saving $200,000 from scratch, they're leveraging past growth. This is one of the biggest advantages in real estate. It builds on itself, and that's why so many people at the higher end of the market seem to move up so quickly. They're not saving their way there in a straight line. They're using momentum. There's also the role of investments outside of real estate. High-income individuals often allocate a portion of their earnings into stocks, index funds, or businesses. Over time, these investments can grow significantly. And in some cases, they can even be used strategically during the home buying process. For example, instead of selling investments and triggering taxes, some buyers use asset-backed loans. They borrow against their portfolio to access liquidity while keeping their investments intact. This allows them to make large purchases without disrupting their long-term growth. Again, this is something that isn't visible from the outside. All people see is the house. They don't see the structure behind it. They don't see the years of investing, the accumulated equity, or the strategic decisions that made it possible. And that's where a lot of misconceptions come from, because if you try to replicate a $2 million lifestyle using only a salary, you're going to feel stretched very quickly. But if that lifestyle is supported by multiple streams of income and a solid asset base, it becomes much more manageable. There's also a psychological difference. People who rely solely on income tend to think in terms of monthly payments. Can I afford this payment? Does it fit in my budget? People who have assets think in terms of overall financial position. They look at their net worth, their cash flow, their investment returns, and how all of those pieces interact. The house is just one part of a larger system. And because of that, they're often more strategic in how they approach buying. They might put down more than 20% to reduce their monthly obligation. Or they might put down less and keep their money invested elsewhere if they believe it will generate a higher return. They're not just trying to get approved, they're optimizing. Another key factor is diversification of income. At higher levels, it's rare for someone to depend on a single source of income. They might have a primary job, but they also have side businesses, investments, or partnerships that contribute to their overall earnings. This diversification reduces risk. If one income stream slows down, others can compensate. And that stability is crucial when you're dealing with large financial commitments, because the higher the price of the home, the less room there is for instability. A $2,500 monthly payment is one thing. A $12,000 monthly payment is another. At that level, consistency matters, and assets help provide that consistency. They create income streams that aren't tied to your time. They build a foundation that supports larger decisions. And over time, they make it possible to afford things that would otherwise seem unrealistic. This is why focusing only on income can be misleading. Someone earning $300,000 a year with no assets might feel less secure than someone earning $150,000 with a strong investment portfolio and multiple income streams. Because the second person has support, they have options, and options are what ultimately define financial strength. When you look at high-end home buyers through that lens, everything starts to make more sense. It's not just about how much they earn, it's about what they own, what those assets produce, and how they structure their finances to make everything work together. Most people think affordability is about whether you can make the payment. That's the baseline. That's the minimum requirement just to stay in the game. But real affordability, the kind that actually supports your long-term financial health, isn't about whether you can make the payment. It's about what happens to your life after you make it. That's where margin comes in. Margin is the gap between what you earn and what you spend. It's the leftover, the buffer, the space that gives you room to breathe financially. And when it comes to buying a house, that margin is the difference between feeling in control of your money and feeling controlled by it. Because here's the reality. A house doesn't just cost the monthly payment you see on paper, it comes with layers of expenses that build over time. Property taxes, insurance, maintenance, repairs, utilities, unexpected issues that always show up when you least expect them. So when someone stretches their budget to buy a home at the very edge of what they can afford, they're not just committing to a payment, they're committing to a lifestyle with very little room for error. And that's where problems start. Let's say you're earning a solid income, and after running the numbers, you realize you can technically afford a $4,000 monthly housing cost. The bank approves you, everything checks out, and on paper it works. But what does that actually leave you with? After taxes, maybe your take-home income is around $7,000 to $8,000 per month. Now subtract that $4,000 housing cost. You're left with $3,000 to $4,000. From that, you still need to cover everything else. Food, transportation, insurance, subscriptions, personal expenses, savings, investing, and suddenly that leftover amount starts to shrink quickly. Now imagine something unexpected happens. A medical bill, a car repair, a temporary drop in income, or even just an increase in everyday expenses due to inflation. Without margin, those situations don't just feel inconvenient. They feel stressful because there's no buffer to absorb the impact. This is why two people with the exact same income and the exact same house price can have completely different financial experiences. One feels comfortable, the other feels stretched. The difference is margin. The person with margin isn't just thinking about today, they're thinking about flexibility. They're leaving space in their budget for things to change because they understand that life is not static. Expenses fluctuate, priorities shift, opportunities come and go, and if your financial situation is too tight, you can't adapt. That lack of flexibility shows up in ways people don't always expect. It shows up when you hesitate to invest because you're worried about cash flow. It shows up when you pass on opportunities because you can't take the risk. It shows up when you stay in a job you don't enjoy because you need the steady income to cover your fixed expenses. In other words, your house starts to dictate your decisions. And that's the opposite of what most people want. They buy a home thinking it will give them stability, but if they overextend, it can actually limit their freedom. Now compare that to someone who deliberately builds in margin. They might qualify for a $600,000 home but choose to buy at $400,000 instead. Their monthly payment is significantly lower. Their fixed expenses take up a smaller percentage of their income. So what happens with the difference? They can invest it, save it, use it to build additional income streams. Or simply keep it as a cushion that allows them to handle unexpected situations without stress. Over time, that margin compounds. Because while one person is allocating most of their income toward maintaining their lifestyle, the other is using their excess to create more opportunities. And those opportunities can turn into assets. Assets that generate income, assets that appreciate, assets that eventually reduce the need to rely entirely on active work. This is how margin connects directly to long-term wealth. It's not just about comfort, it's about growth. Without margin, it's very difficult to build anything beyond your current situation. You're constantly maintaining, constantly balancing, constantly trying to stay on track. With margin, you can move forward. You can take advantage of investments when they appear. You can weather downturns without panic. You can make decisions based on strategy instead of necessity. Another important aspect of margin is how it affects your mindset. When your finances are tight, everything feels more urgent. Every expense feels heavier. Every decision carries more pressure. But when you have margin, there's a sense of control. You're not reacting, you're choosing. And that shift in mindset often leads to better financial decisions over time. You're less likely to take on unnecessary debt, more likely to invest consistently, more likely to think long-term instead of short-term, all because you gave yourself space. This is why the idea of maxing out your budget can be so dangerous. It assumes that nothing will change. It assumes that your income will remain stable, your expenses will stay predictable, and your priorities will remain the same. But in reality, none of those things are guaranteed. So building your financial life around maximum capacity leaves you vulnerable. Instead, the goal should be sustainability, a level of spending that you can maintain comfortably, even if conditions shift. And that's where margin becomes non-negotiable. It's not a luxury, it's a requirement for stability, especially in a time where economic conditions can change quickly and the cost of living continues to rise. Having that buffer isn't just about peace of mind, it's about resilience. It's about being able to handle uncertainty without it completely disrupting your life. And when you apply that to housing, it changes how you evaluate affordability entirely. Instead of asking, can I make this payment? You start asking, what does this payment leave me with? Because what's left over is what determines your quality of life. It determines your ability to grow, to adapt, and to stay in control of your finances over the long term. And once you start thinking that way, the size of the house becomes less important than the strength of your position around it.